No, you haven't pressed
All
live.
right. And
Okay.
we are back once again with another episode of Exit Liquidity. And this time we are joined by none other than Jedi Blockmates himself, the legend. And we have Captain Rational, as usual, sitting in his chair of rationality. So, boys, what did anything of note happen this week?
Is that an actual question? Oh my goodness.
Was that
That's
it's a rhetorical question, and the
Yes,
answer is yes.
yes, it
well,
is.
what is it? It's taking us back in time. Well, I mean, obviously, it's taking us back in time countless times throughout history. It's disturbing. It's a state of insanity, or at least it's a period in time where a population is expressing themselves in the worst possible way,
Yeah.
as in the most irrational possible way. It's a fragmentation of society, and
I
what,
think I think that we have seen, and it's been a slow decline, and I think everyone's felt it, right? Is the slow breaking of the social contract.
good
And
phrase.
it's a great phrase. And if you've never read the book, The Social Contract, like it's one of those books that like I read it in college and it really changed my views on just government in general and politics. And I mean, really, all it does is it's just a study of governments and politics and what their pluses and minuses are. But like, it's an incredible book, and it's just one of those books that like, if I had to pick like a list of 5 books that kind of like changed my perspective in a very dramatic way, that would be one of them. Um, but yes, this week, I mean, a potential assassination attempt on a former president of the United States who has expressed quite a
And
bit. Well, he's
an interest
expressed
in Bitcoin.
an interest in Bitcoin and crypto in general, an interest in ousting the OCC, not to mention all the Supreme Court decisions that we've had. So, like the repeal of the Chevron decision, like, and some of those other ones. I don't know if you were following those.
That is a massive change
Yeah.
of things, the Chevron deference
Yeah.
standard. And I like that because not just because of crypto related considerations and the SEC. I like that for other business related reasons also. Regulators are what are regulators? It's an extension of the executive. I mean, in my opinion, that's insane. Uh, the judiciary.
Well, yeah. As somebody who used to work like in a super heavily regulated industry, um, you saw the regulatory creep when the regulators arrived. Like they would every time they would push a little deeper into, well, that's not how we viewed this before, but now this is how we're going to interpret this part, because it gave them something to pick at, and they could go from place to place, and they could pick at this one thing, and it kept them busy and it kept them with a job. And I I think that regulatory creep is very real. And I do think that Chevron will be very big in helping to rein in some of that. And it also forces Congress's hand. I mean, if you don't like the fact that the regulators have been defanged, so to speak, um, Congress can fix any of these problems. They simply have to pass laws. Um, and and I think that's kind of the point, is that uh, you want your you want these sorts of rules and enforcement actions to have gone through some sort of legislative uh, process, rather than just uh, some kangaroo court,
Discretionary.
and just so, I mean, it can literally just be the whim of one particular regulator who just says, I think this is reasonable, I'm gonna punish
The
these
funny
guys.
thing is, they are very critical of our relative rights to discretion. Yet they have taken an extreme amount of discretion with regard to what they are attempting to enforce according to their subjective opinions. What would be nice, actually, which I don't know if it exists, from Congress is a rigorous process, not a full court process, for reconciliation. It's something that uh, uh, that is in business documentation, to get out of the courts, because the courts are a slow process. But that'd be something that'd be nice, a happy medium for reconciliation of discretionary matters, interpretation matters that don't require necessarily a full court process, but still go
Right.
through the judiciary.
Yeah, maybe something where it goes to like some subcommittee or something instead, rather than the entire Congress. But
But another kicker is, though, it has to set precedents. This whole, like, run it through a subcommittee of Congress with oversight of a judge, and set some damn precedents on everything, because
right.
that's the whole point. You get rid of Chevron deference, and you need to go back to common law.
Well, and that was the issue that came up in crypto this week too, with finding out that was it the SAB 121 or whatever the hell it's called, rules where the big banks, we found out, have special deference from those rules. Now, banks obviously have very rigorous reporting standards and criteria. So I'm not even saying necessarily that that decision was incorrect, but like, when you don't even have documentation of why the decision was made, because like there was a reporter that asked them like, hey, what's up with this? How come these banks all don't have to comply with it? Well, they're like, well, it's more of a guideline, and somebody decided it was okay, and so that is like just so un-American.
Well, it's an
Like,
expression of discretion, and discretion is very much part of rules. Now, it's unfortunate when this is a government regulatory body that is expressing this subjective discretion, whereas you would think that everything should be much more in favor of the individual, and there should be a greater burden on regulatory authority as compared to the individual.
yeah.
Because in the end, like, that discretion by the regulatory authority was by an individual that shouldn't be expressing him or herself. It should be
No.
representative of the regulatory authority, which is really a representation of everybody.
Right. And well, that, and combine that with, I mean, using the example of crypto, the inability of the regulator to even express their worldview on what is and isn't a security, outright refusal, I would say, to express what is and is not a security and what rules need to be played by. And then meanwhile, you have the CFTC chairman saying like 80% of tokens aren't securities. And so it's like the right hand isn't talking to the left, and I mean that both, literally and figuratively when I speak right and left there. Um but it is I think we are in need of some change, because so many of these regulators have gone well past what they consider to be their mandate. And I think that some reeling in from Congress to say, hey, your mandate is this, stick to this and only this. And if you want to go further than that, we'll talk about it, I think that's a reasonable take.
What do you think, Jedi? We understand where we are. We understand what happened over the weekend. We understand how crazy the regulators are and how everything's changing. Do we understand this? Do we even understand what we're talking about?
I mean, have we ever?
Isn't this always a journey, though? We're trying to figure this stuff out.
Well, I mean, and that is the thing. Is like this podcast is and always has been a journey of like just self-reflection and joint reflection, really, because it's not really a monologue. It's always been me and Captain and occasionally a guest, and we come to some sort of like mutual understanding and bounce ideas back and forth, and I think that, at least for me, is part of my learning process, and I think it is for you too, Captain, is just this like saying things out loud and exploring these ideas. So
Well, I'm still going. I'm still figuring stuff out. But you know what's interesting? Back in the day, we used to see charts. We used to watch other macro talks, macro podcasters. But nowadays, frankly, I have my own opinions, and obviously you as well. And I find other folks' talks interesting, but I see much simplification in the data, and I see very interesting charts and from a reductionist perspective. And there's one chart in particular that I happen to love, and I think it tells a great story of where we are.
let me bring up the charts just because it seems like you're queuing that. But Jedi, did you have anything you wanted to add before we get to the charts?
Just to your original question as to what my thoughts were around the regulatory and Chevron particularly, is my litmus test in this regard is how does Elizabeth Warren react, said scenario. And, if she's unhappy, then I'm automatically happy. And if she's happy, then I'm automatically unhappy.
I mean,
Really,
I think we can all agree to that. Yeah. I don't know.
Cope? She has to cope?
Yes, cope will be a good word for it. She'll find a way to work her wormy fingers into this somehow.
Here's the kicker. What's crazy about what has been the status quo is you could go to the judiciary. It's a separate branch of government. If a regulator is coming to stating something, they can't conclude it any longer. You cannot
They
defer.
have to go to court. They have to go to court, and they've been getting their asses handed to them in court.
Because, for a very simple reason, their arguments are not rational. You cannot argue against rationality, ladies and gentlemen. It is logical. It is natural law.
The captain would know.
So, I mean, before you get onto the chart, I think what's really important as well in the context of regulatory kind of like milestones and clearly stuff that needs to be worked out, particularly over the next 5-10 years around crypto, is like what is currently happening in the political landscape from a regulatory perspective. And more importantly, we've had an administration that's been very much from deeds and actions very anti-crypto. We had banks being closed down and this whole operation, whatever it was called, and now all of a sudden there's this realization that there's actually several million people in America that, have a vote, who are interested in crypto and work in crypto, and it's now becoming a political thing. And I think the relevance of that is huge. Like, I think it can't be overstated enough how significant this whole thing is playing out, because we always kind of imagined Bitcoin particularly to be this form of money, but now it's becoming a political weapon to the extent that we've got Donald Trump on record stating that he was pretty much opposed to crypto several years ago, and now he's done an about turn. And listen, whether he means it or not, I don't want to discuss that. It's not really.
I mean, the guy is not exactly famous for being.
He's not the most honest fellow in terms of his past record. But right now, that is almost insignificant in light of the game that's being played on the political landscape. And someone tried to assassinate him this weekend. And believe it or not, the reason why Bitcoin is pumping right now, in my opinion, is purely because the market is pricing in the fact that we have a pro-Bitcoin president potentially coming in. And after that photograph that was taken with him with blood on his face and his fist raised with the
Oh my
American flag in
God.
the background,
I mean,
it's
the
like,
guy
how
nailed
can
that
you
moment.
not?
Done deal.
How,
The
I
guy
mean,
nailed that moment. I despise the man. I
I
really
think
do.
a lot of people do, but it's like, how can
But
you even? How would you bet
he-
against him right now? And
I-
how
But
is
it's
this guy?
irrelevant, Ben. What's
it, it,
pertinent is
it,
that's it. And
yeah.
that's for better or for worse. Yeah,
Yep.
that was a lovely. How can you say lovely photo? It's a disturbing photo, a
Yeah, I
disturbing
But
mean,
reality. But
it is
that
an
is a
it
iconic and
is
powerful.
yeah, it is absolutely iconic, and that photo will go down in history for sure.
100%. And that's where we're going now, gentlemen. And whether we like him or not,
Yeah,
he's the one who's actually driving that Formula One car down the straight, and there's no one in sight.
and
That's the way I see it.
I
Very
think
much.
that there have been, I mean, in light of all the Supreme Court decisions that have been made over the last few weeks, because there were a bunch that came down. It wasn't just Chevron. I can't remember the names of the other ones, but there were a few. And as we get to the charts, let me just pull up one that I feel is very relevant to crypto. This right here is the chart of stable coins.
It hasn't even started yet.
And these are particularly like fiat, like
I'm sorry.
RWA backed stable
These are
coin.
dollars.
Yes, these are dollar liabilities.
Yeah, there you go. And
Dollar
because
liabilities.
99% of dollars are dollar liabilities, these are dollars. Dollar
Yeah,
deposits. These
right.
are
Well,
these are
and they're generally backed by U.S. Treasuries. Now, the SEC recently had to throw out their case against BUSD, which I haven't actually checked if BUSD has actually made any sort of. Nope, it's still dead. But
That's crazy. They literally killed it and they dropped the case.
yep, they did,
That's such a
because
dick move.
it is a dick move. There's no other way to put it. But as this is a macro podcast, I don't want to just focus. Let's zoom out a bit, because I think that people right now are talking a lot about interest rates coming down. And I think that there's a lot. Here's one of your favorite indicators there, Captain.
Hmm.
The NFCI. This is the Financial Conditions Index that's published by the Fed at Chicago, and it's way down from where it was, which is interesting, because this takes into account. We dug into this one of the podcasts way back, where this takes into account like a whole bunch of things, including some of the global Eurodollar type inputs. And I think currency wise, I mean, some interesting developments in the Japanese yen have been taking place. We saw it, you know, they have plausible deniability, I guess, but they're like, yeah, we may or may not have had some open market operations on the yen. I think that red candle would say otherwise.
So the system is structurally imbalanced with its interest rates, and this chart can't go down unless they invalidate basically good parts of the yen carry trade. If you can borrow cheap at whatever the hell a prevailing interest rate over there is, 0.5%, 1%, and
Right.
lend to the U.S. government at 4.5%, 5%, everyone's going to do it because they're not lending at a 4-point spread. They're lending at a 40% spread, 10x leveraged. So they get
Yeah.
40% on cash, which is
Yeah.
insane.
And you have seen some of this too, is like the interest rates on some of the Japanese bonds, JGBs, have been also on the upswing, and
It's not enough. Not
it's
even close to enough.
not even close to enough. But it can put some pressure on the carry trade if they push that high enough, and the US brings their interest rates down. And then I think that right there is really the crux of what's going on with interest rates, and why you hear these talks of lowering interest rates. And what is lowering interest rates about? It's about changing monetary global flows. And this, like, and these are short-term interest rates, but like right now, this 5.28 you can get on a 1 month, that's pretty damn good, and you ain't gonna find nothing like it outside of, I guess the British 1 month, they decided they had to keep theirs high in order to even
Oh, look at that.
compete.
Would you look at that?
I
Look at the
I
spread. Hey, why don't we chart the spread between 10-year JGBs and 10-year US?
So this is the 10-year, actually 10-year.
You know what I mean?
Yeah.
We-
Well, I have a similar thing for the 10-year Italian and the 10-year German, which is interesting. But the spread between the 10-year JPY. All right.
Oh, yeah.
Well,
When you're looking at Italy versus, you're talking about Euro chaos, and that was a big topic between debt from the north and debt from the south and flows, and that's all the complexity we remember from Greece back in the day, and everything
yeah.
blew up. But obviously, the world from a macro standpoint is probably best expressed between with the yen carry trade and how the Japan finances U.S. deficit spending.
What? All
Like
right.
literally there.
Edit this.
Just whilst he brings that chart up, I wanted to just ask a very general question for the ignoramus in the room, namely myself. What is the relevance of kind of like the Japanese yen in its current kind of stance in comparison to the US dollar? Because I know that you were mumbling about it, Mr. Captain Rational, for a while, in terms of like, okay, listen, Japan's in a bit of trouble here. Where does the trouble originate from? What is the kind of like the complexity around that in simple terms?
Everyone's backed into a corner. So they have
Yeah.
a problem because everyone's in Japan, you want to invest outside the country, and that's propping up the dollar price. But the dollar price is inflationary, relatively respectively domestic. So as the dollar is more expensive, everything in Japan is that much more
Okay.
costly.
I don't know why it worked
Yeah.
that time. All right. Finally got it to work. All right.
It's lit. What is that? That's not parasitic, but that's like it's self-annihilistic. It's like
Yes.
all the
So
bankers and investors want to invest, propping
this
up the
is
dollar.
a fascinating chart. This is
Oh,
indeed
okay.
a fascinating chart, because look at
Oh, look at the
October,
pattern.
October 22, October 23. Now, I have this little I did a tweet thread. I don't know if you saw it, Captain, but I did a tweet thread because I noticed something that I thought was very weird. And it was, so I was looking at the fact that, I mean, we've talked about the RRP many times. And how, like, you see how it's just kind of stagnating, because like I don't think the Fed wants it to go any further down. They want that
Buffer.
cushion. They want that cushion because as soon as you remove all the RRP, then you're back to repo, you're back to QE, and they don't want to be in that place. Maybe not as soon as, but like it gives you $400 billion worth of buffer.
Which really isn't much, but that's another story.
It's really not. But what I find interesting is I found this. Speaking of $400 billion, this right here is also RRP, but it is not. It is a different line item on the Fed's H1, and it's for foreign RRP. And what I find fascinating is the fact that every single time that Japan starts not intervening in their currency market, this thing skyrockets. So like
Yeah.
look at these dates, like August 22, boom.
Are those the
October
dates? Are those the
October
intervention?
October 20, well, it was October 22. So it would actually be more like right here. Well,
All right.
that was when those spreads, but like here's September 23, and then we just had another one. Literally, I did this tweet thread, and then the next day they had that big intervention, and it shot up again. Like,
So they're not buying dollars on the open market because
no.
if they
Well, it's interesting because this is not repo. Repo would be, we need dollars, right? Repo is trading dollars for or repo is trading treasury securities for dollars, right?
yes,
So,
they got 1 trillion of them.
well, but this is
But
reverse repo. So
this is reverse repo.
this
Okay.
is reverse repo, which is trading dollars for just yield, basically, or treasury securities. And
Putting in the dollars.
And well, and then they may, or what happens after they take those treasury securities? I don't know, but it's very interesting to me that, like, you know, you see this national financial conditions index, and it's like down only, and it's like, okay, people are allegedly short dollars, but you know, you look at the DXY and you go, well, no, because the yen's the dollar is being devaluated somehow, and I'm trying to piece together how. Like, by what mechanism is this happening? But like, the fact that this foreign facility, which maybe this speaks to the fact that, like, because
So
we've kept
small.
interest rates so high for so long, the amount of foreign dollar liabilities has gotten quite large, in that private credit has created many dollar liabilities that have found their way into banks, and then from there found their way into the Fed.
Well, the kicker is if you're pumping in 400 bill offshore, they're borrowing treasuries. You can't lever dollars, so you got 400 bill, but you can sure as hell lever 400 bill worth of collateral 10 to 1.
Right. And what's interesting about this facility, this is called the FEMA repo facility. And what's interesting about this particular facility is that there's zero visibility into this damn thing. Like, it's not like a swap line where every Wednesday you can go check and you can see who has taken on a swap line and for how much.
Oh, this is the good old boys club right here.
This is like, this is the same facility that the Swiss used instead of the swap lines. Now, when UBS was taking over Credit Suisse, like as Credit Suisse was failing, they used this very facility instead of swap lines, even though the interest rate is higher, allegedly. We don't actually know. It's opaque. But allegedly the interest rate is higher on the FEMA repo facility than it is on the swap lines. But, you know, the swap lines haven't budged, but this sort of opaque and mysterious facility has been you know, going to the moon. And
It's only 400 bill though, but here,
right, but it's indicative of the fact that there are dollars overseas that need somewhere to go. and it explains like where did this bottom? December of 20, okay, and then March of 22. Like think of crypto prices, August of 22. Like I like these dates sort of kind of follow the general expansion of liquidity. Let's go to Bitcoin and let's take a look.
This is a good old boys club leverage facility.
Yes.
Where so that's fascinating.
I mean, the point of it originally, was to provide liquidity in areas where, because the US does not want to provide swap lines to everyone, because when you provide a swap line, you're taking on counterparty risk, right? Like, to put this in the terms of a lending and borrowing protocol, it's like which stable coins are you going to allow to mint your token versus which stable coins are you going to just have other people provide liquidity and borrow against?
We're back to global Aave governance. Everything comes back to global Aave governance and health factors.
I mean, it's all the same shit, and to pretend like it isn't is just being like disingenuous. But look at this. I mean, that Japan intervention, boo, straight up ever since. And then like, oh, here's November 22. That's strange how that date, October, November 22, keeps coming up again.
That's a good date. They need to structure. So the problem is they're going one-offs.
And here's October 23. Like, these dates are important, and I mean, it's because
you just click that tap USD. You wanted to. You scrolled by it, and you wanted to click it.
I'm not gonna click it. I'm not gonna click that chart. I will not.
They're close though to getting. So they've done these one-offs, and they have facilities. That's the kicker. That's why it's always different this time. The story's always different. They have all these facilities, and they didn't have reverse repo prior to 2020, and now really
they had reverse repo. They didn't have FEMA until 2020. They had reverse repo. It just wasn't used
at all.
Like, it was used like very little. It got some use in the early part of the decade.
Wasn't structural use.
Yeah, it basically came out of 2008 is when reverse repo was created. Now, but this FEMA facility that I was talking about, this was specially created when you had the dash for cash out of COVID. Well, maybe this line item wasn't, but the FEMA facility itself was created during 2020. So, yeah, it's interesting. And another thing to note here is look at M2.
Bottom.
Oh, October 23. Is that date relevant somehow?
Oh, time and time again. Everything makes sense in hindsight. But this needs to expand. It needs to. And for better or for worse, and it will.
Yep. Yes, indeed.
What I wouldn't mind seeing some dates related to DTCC, and it's a complete centralization of Treasury clearing, and how that correlates with like Move.
Well, so DTCC hasn't been fully implemented yet, right? So
got to be implemented to some degree. I mean, I think
it's going to be. I think it's going to be sort of like LIBOR, the LIBOR to SOFR transition, where it's going to be something that happens slowly over time. Now, one thing that did happen is that recently, and it is sort of under discussed, is that they've transitioned to T+1 settlement rather than T+2.
Increases
And
liquidity.
yeah, apparently it also causes some problems, I've heard, because a lot of the other global similar entities are still on T+2, and so depending on who your counterparties are for like certain like derivative trades and stuff like that, it can get wonky when one trade isn't going to settle in time. Like if you try to make a trade on a Thursday, it's not going to settle on time or something. I don't know. You're getting a little out of my depth at that point. But
Well, it's interesting. The simplification is that it must increase liquidity. If capital is available in 50% less time, that is by definition an increase in liquidity. And frankly, that's what this whole system is about. It's available capital, and we see it. We see it clear as day in collateral volatility, literally falling off a cliff over a 2-year period.
yeah, and so here is kind of a representation of collateral volatility right here. Is this is, I mean, aside from the move, but this is just the 1 month minus the RRP. And this thing was all over the place. But I think mostly this was rate hikes here. So maybe that's not a great example. But let's look at the move, because the move is falling off a table. And
This is the holy chart, Jedi. You could zoom this out to 2002, and you could have a story. It tells a story.
Let's put this onto a captain friendly
6 months.
Oh, I mean, 3 months not enough. You need the 6. I think
Even
3 months. These candles are big enough.
Look at that shit. It tells you everything. It tells you three significant episodes, like 3 most significant episodes in recent history is 2008, 2020, and the end lead up until 2022 when Bitcoin rolled over.
Right.
And if anything, all we like to look for correlation, inverse correlation with our favorite asset prices, and that's all fun and fine and dandy. But it's very significant when collateral is volatile. Nobody wants to freaking lend. The banks don't want to lend, and people don't want to borrow because the global Ave health factor is all messed up. But with collateral volatility, it's a very relevant phrase. Listen, if Ethereum's going from $2,000 to $4,000 5 times a week, nobody's messing around with a 1.2 on Aave. They want a 3, a 4, or a 5. But if Ethereum is $3,000 for 6 months, people are going to crank it down to 1.05 and be like, oh, Ethereum, the collateral prices aren't budging. So that's exactly what this is. If you take it to, a $270 plus trillion global market,
and that is exactly why I think you are seeing this number blow up, because we suddenly stopped hiking interest rates, and now you're seeing some of that global dollar production make its way into the RRP by way of this
oh, that's actually a good point.
facility.
We're seeing ancillary effects of collateral volatility rolling over, M2 pumping up, excess dollar supply creeping into the system. This is all forward-looking indicators.
Right.
Oh man,
look at this. This peaks in January of 23. Move does.
Mm-hmm.
Move peaks in January of 23, and let's see when. So July of 23 is about the last local bottom. This is a 3-month chart because this is a captain size chart here. But let's see. I guess it hasn't really moved. Yeah. Yeah, Captain's got to go at 9:45. But Jedi, how about you stick around and we'll continue some discussion. But so any parting thoughts?
Yeah, talk to put it into terms. Like we stare at charts, we understand charts, but put it into terms. Throw in a couple of questions, Jedi, and I like bringing things back down to earth and simplified way to understand things. It's like that's why I say global Ave health factor, and that's why I talk about the move so much because it's a reductionist perspective. It's a way to understand this insanely complicated world through a simplified lens. Like, what are we really looking at, and what are the indicators that really matter? That's going to tell us what the hell is going on in this system, and I think we're so damn close. The system hasn't started. We've seen just forward-looking indicators of things starting to expand. FEMA repo, just a little bit of excess cash because it's a couple $100 billion. When you start to see M2 and trillions, global M2, trillions expand, and you see move roll over into the 70s and the 60s, that's when things get weird. And they're so close to getting weird.
Yes, they are. And I think that's why I think the title of this episode was Flood Warning, in that I think that the Bitcoin price is telling you and that things are going to get weird, and that you may see that this stuff isn't going anywhere. Crypto is not going anywhere, and the manipulation that's taking place on a global scale is inevitable. It's simply inevitable because you cannot control every facet of you can either control capital flows by
Collateral
way of
pricing.
by way of capital, like capital controls, like you can't let your money leave the country. You can either control your currency or you can control your bonds, but you can't control all three. Like, and everybody sees these countries like JPY and China and to some extent and Europe and the US, and they see this and they recognize that the only way out of this is a devaluation of the dollar. So looks like we have lost the captain, but Jedi, what have I missed? What is at the top of your mind?
So I think, I mean, this is obviously all very relevant. Like when you get down to the brass tacks of the whole thing, and I don't think there's a better term than that. And it's all fine and well, but I think at the end of the day, for me, like, what does it really mean for my bags? And
For your bags, for your bags long term, I think it means nothing but good things, that you're going to have these fiat systems that are going to struggle to maintain themselves, and their only option is, as Lynn Alden puts it, is fiscal dominance, which means being able to take the the currency and devalue it in order to help pay off their debts. Because really, there is not really justification. If 2% is your long-term interest rate, like, look, this is the 10-year break even on inflation, and it ain't below 2. Your job ain't done.
it never has been. Well, it was,
I mean, here's the 5-year or 7-year, and then the 5-year, and none of these are below 2.
Yeah.
And so how do you, when you have a ballooning debt that's becoming a greater and greater percentage of your global GDP, you have no choice but to make number go up. Especially, and this is something that Luke Groman always talks about, is the he always talks about the fact that like so much of the government's revenues, tax revenues, are coming from capital gains, that they literally have no choice but to make the number go up, and then maybe down again, and then up again, but definitely up again. Because they want people trading on this volatility, because it's the only thing they got. Because they keep lowering taxes, and they keep on spending more money, and you, if you do that while keeping interest rates high, and running large deficits. Somewhere I've got the federal deficit chart, but I don't remember where
So
I
that's
put it.
like 33 trillion at the moment.
It's very high. Let's see. I don't know where I put that one, but the point is that like it's like I think it was something like 11% of GDP or something like that. And when your deficit gets that high, you start to run into real problems, and your ability of your banks to create money beyond the money that you're creating by running these massive deficits, like your control over interest rates. This was something that was in Lynn Alden's last piece that I reposted yesterday, is that like in the US, everybody has fixed rate debt. Like most actual people have fixed rate debt. And like most mortgages are fixed rate. I think it's something like only 5% of people have floating rate mortgages. And that's the biggest debt that your average American citizen has. And so if you are going to have a country where no one has floating rate debt except for the banks, because they're the ones that are hedging all the floating aspects of debt, and then you're going to crank up interest rates, who do you think that hurts? It doesn't hurt the average American. Like when my mortgage is 2.5% and the interest rate on a 1 month treasury is 5.2, you ain't hurting me. Because I could literally just take my money, put it into treasuries, and then like just capture that spread to pay off my debt. But what you are hurting is you're hurting the banks that are holding that loan on their books, because they loaned you that money at that rate, and now they're collecting every month 2.5%, when a 1 month treasury could be yielding them much more. And so this is why they aren't going to lower interest rates to help out normal people, I don't think, because they're going to lower interest rates to fix the banking system and bail out the banks, and they're going to lower interest rates in order to put the geopolitical pressure, take the geopolitical pressure off of some of our friends like Japan, who are having some serious issues with their currency. And by lowering our rate relative to theirs, it it helps to relieve some of that pressure. It relieves those outflows, particularly from those countries that, you know, do have lower interest rates than us. You know, your Germany's, like Germany's only yielding 2.4% on their 10-year, and on top of that, they have no energy. Like they're having to import LNG because they can't get it from Russia anymore. Their entire industrial base is having issues because they have very expensive energy. It and they have all this energy intensive manufacturing, and you know, Europe in general is having some serious problems, and the ECB has been like champing at the bit in order to try to get us to lower interest rates because it will relieve considerable pressure from them. But I don't know. Any thoughts?
So, I mean, for me, it just comes down to the fundamental question around crypto, and that is that we've obviously seen like a huge kind of like disparity between, you know, equities and kind of like TradFi and what's been happening there. It's been up only. I mean, S&P hit all-time high at the end of last week, and you know, it's essentially, you know, we're talking proper crypto parabolics happening in TradFi at the moment. Nvidia, you know, like all the technicals say that Nvidia has kind of like reached its max, but in fact, what it's doing now is consolidating and more than likely going to do another push up. And we're seeing all of this really positive sentiment in TradFi, but crypto has been really kind of like the last 3 months has been in the doldrums. And I'm just curious as to, you know, is there kind of like a rational basis from a macro perspective in terms of what's going on with crypto? Or is crypto like distance itself from this whole thing? What is actually going on there?
I think crypto is to some extent kind of like an emerging market, right? And
you have said that many times before.
I have.
And I think you're right. Yeah.
And I think that what has happened though with crypto, at least in the last couple months, has been largely I mean, Germany just dropped what was it, 148,000, or maybe it was just 48,000 Bitcoin.
50,000 pretty much, yeah.
Yeah. Yeah. So they dropped that, you know, a clip of, you know, I think it was like 16 times the normal issuance of Bitcoin in a week. So like it's being used, and this is the bullish thing about all of that. Is that these countries, like in Japan too. Japan, all of a sudden the Mt. Gox stuff got sorted out. It's been sitting in courts in Japan forever. They finally announced the deal. The deal was you get like 8% of whatever you were going to get. Where that other 92% went, I don't know. But my guess is that it also was getting sold into the market. I don't know. That's just a theory I have. But like you saw this too. Back when the let's see, where's the appropriate chart here? So this is the Treasury General account, right? And so remember when the feds were not passing the budget or whatever, and this thing ran down almost to zero?
Yeah.
This is when Janet Yellen reached under the couch cushions and pulled out all the Bitcoin and sold them. And Germany, same thing. Like they're waiting for these rate cuts to take place. They're trying to survive. And because they also, I believe in Germany, have a constitutional mandate to pass a balanced budget after, you know, the happenings of World War I and World War II. For some reason, they don't like debt anymore. Um, but
But they're about to borrow $50 billion from the ECB. I read this morning.
I hadn't read that, but
Yeah.
that is interesting. Like, but in general, that just shows their level of desperation, though.
I think so. I mean, it
I
seems
think,
like this
and
Bitcoin style was desperation. In
exactly,
terms of
it
how
was,
they went about it, it was really quick,
yes,
complete, like, yeah.
this was a forced liquidation. This is
Yeah.
forced selling on the part of Germany. And I think the bullish part about this is they are treating this like a reserve currency.
Yeah.
They are 100% treating Bitcoin like a reserve currency. It's something that you hold on your balance sheet, and when shit gets rough, you sell
use
it
it.
in order to get dollars, because dollars get scarce because this global money printer gets out of control every now and then. And when the dollar money printer gets out of control, what do you got to do to pay back your debts? You got to find dollars somewhere. And the fact that move is going down, this was a function of the US Treasury issuing tons and tons of T-bills over, like way past the historical norm. I think it was 22%. 22% relative to a historical norm of like 15 to 20.
Wow.
And so Janet Yellen's been accused of trying to like pump markets prior to November. I think maybe there's some of that, but I also think some of it is that move was becoming deeply illiquid, and because you can, I mean, not move, but like US treasuries, which make the world go round. Like literally, without the US Treasury market, the entire dollar system would collapse. And things got incredibly spicy in March of 23. They got incredibly spicy in March of 20. They got also, again, this date, October 22. Things were getting out of hand, and they were having a lot of illiquidity in the US Treasury market. And the way to fix illiquidity issues is to just dump a bunch on the market, and now it's liquid again. Like, volatility and liquidity are two sides of the coin. Like, you can have one or the other. It's very difficult to have super deep liquidity and super high volatility. And this is something that I think everyone inherently understands, is that, like, and even Bitcoiners. I mean, I don't mean to say even Bitcoiners, but the whole idea of like, oh, the issuance is, oh, the halving. All right, now there's fewer Bitcoins. That means the price is going to go up higher and faster, and it'll be more volatile. And it'll shoot up to the moon. And I think this is a concept that people inherently understand, is that like when there's fewer to fight over, then you're going to see
Demand rise.
Well, yeah, you're going to see volatility go up.
Mhm.
Volatility is going to be all over the place as markets become deeper and or as they become more illiquid.
So a question for you around kind of like the reserve, Bitcoin as a reserve currency and the basis thereof. If that is the fact or the case, why is there no basis for Bitcoin being used as a collateral in order to borrow money?
I think you absolutely will see it. You just won't see it on chain, not until the tech stack supports it.
Yeah.
Right? I mean, like it's probably already being done, to be honest. Like, especially now that these banking institutions are all like, full steam ahead on all of their crypto. And I think actually that's one of the things that I think there was a ruling recently that they said that they did not want banks custodying
Correct.
Bitcoin. And this is exactly why, I think, because they're afraid of people using Bitcoin as a way to just borrow against it and get dollars. Because that will undermine U.S. Treasuries as the premier collateral. If you can borrow against Bitcoin, because Bitcoin, I mean, nobody buys Bitcoin on a decentralized exchange, and this is my biggest grief with Bitcoin, is that like they refuse to put sufficiently expressive code in to allow the creation of such things. And I do think that there's a lot of talk of Bitcoin L2s and stuff right now. I don't know. I haven't done enough research on it to be certain.
So I can fill you in on that. There's a number of L2s that, well, L1s rather, that claim to be L1s, and then also side chains that facilitate an EVM Bitcoin environment. Whether you believe Bitcoin DeFi is the thing or not, it's happening. And whether you're a hardcore Bitcoiner and you think it's all a crock of shit, well, you know what, sir? You are wrong. And we are entering into a whole new age of how Bitcoin can be utilized in the same way that Ethereum was. And all the benefits of collateralization, lending and borrowing, and looping, and all that beautiful stuff is already being done. I mean, Core
Right.
have got, I mean, they've got over 4,000, I think 5,000 Bitcoin in TVL that's locked, and people are borrowing off the back of it. So it's happening, and it's going to happen, and it's going to be a huge market.
I know that Thorchain also was doing
Yes.
some Bitcoin lending as well. But I saw the way they implemented that, and it scares the hell out of me. Like, read those docs. It's crazy, the things that they're doing.
I think what's happening right now is that you are correct. I think there are concerns, but the reality is that the brave new world is being explored in terms of collateralization of Bitcoin, and it's just a matter of time before working solutions that are, viable and that can allow people to actually be flexible in the space will be an option.
I think that they may have waited too long to build these, though, because I think what is going to happen is that the banks may get the green light to lend against this stuff before this stuff gets built.
It's already built, brother. Core, you can go on Core right now, and it's happening. It's
so tell me, like, about, because I don't know anything about Core.
Yeah.
And that may be obvious. But like, how does the security of that chain, is it a side chain? Is it a layer
side chain?
one?
So they identify it as a side chain, and you've got something like Botanics, which is like with the spider chain, and they're essentially looking at a pure L1. So that's going to launch in the next, probably, I think they're on testnet right now. Probably in the next 6 to 12 months, you will have,
I remember reading through Botanics's materials and stuff. But yeah, I mean, I think that Bitcoin will eventually get to that place where I mean, we're talking about, like, it is in a nascent place. If there's only 5,000 Bitcoin, like, currently being used in it, like, it's still very nascent.
Yes,
and if it's on side chains, that isn't going to necessarily meet the stringent standards of the Bitcoin community at large, as far as the security aspects of it. But I do like to see people building on Bitcoin. I really do, because I think that that has been Bitcoin's biggest. I mean, it is both a feature and a bug. It is a feature that Bitcoin has been this immovable object that has sort of ossified from a development perspective. But at the same time, I think that's also what makes it such a attractive reserve asset, is that Bitcoin, not Ethereum, is what these governments are dumping, because it is it is the thing that, like, it's digital gold. It's which is another thing that happens when that it's another reserve asset that countries tend to keep in their back pocket, is gold, right? And they're treating it like their gold stores. And
as they should.
yeah. So
Yeah, I think for kind of like the greater picture in terms of what's going on right now, from my very limited understanding, and it's like, but it's also quite obvious, is that we are at a definitive crossroads around the way that this asset is being perceived, and it really is starting to change, like before our very eyes. Like I said before we went live, is that it's now become a financial tool, and it's also becoming very much a political tool in light of what's happening in American politics right now.
well,
And
yeah.
that's, for me, is very significant in terms of where we are going and how this thing plays out from the medium to long term.
Yeah, I mean, like, that is very well said. I mean, I think everybody, and not just us macro wonks, not just just your average person on the street,
Yeah.
like, they know something is wrong with the economy and the way that it has been run, and the trust level in institutions is at such lows right now that I think that this is what, our government is scared of, is that the US dollar has been a form of soft power for the aristocracy that runs this place. And that's why we've had Swift and these alternative financial rails. They threaten that power, and so they want to try to quash it, but they just can't. And it's very frustrating to them, but like, everybody can see that this whole thing is spinning out of control. Like, people can't afford to have, like, pay for their rent, let alone have kids. So the demographics are rolling over. We've promised all these old geezers so much relative to what we're giving people in the younger demographics. And so they're just choosing not to have kids, and that hurts it even more, because they've taken too big of a slice of the pie and hoarded it to themselves. And now nobody wants to have kids because they can't afford kids. And because kids in modern society are a luxury item. They really are. It's expensive to have kids. And they're a liability. Like, back when you had an agrarian society where people worked on the farm, that was free labor, and so people had lots of kids because they needed all of those little workers. Mr. Rational, not Mr. Rational. Sorry. He has returned. He has returned.
Oh my
We are
goodness.
still here.
What are you guys talking about? There's a lot of macro stuff going on, isn't there?
Yeah. Well, I was just talking about, like, the fact that, like, nobody can afford to have kids anymore. And we've promised the older demographics so much in terms of, like, what we're going to be willing to give them. And we've created this giant Ponzi. And I think everyone under the age of 40 understands this, or
Yep.
50, even 45, maybe. I don't know. Like, right. They realize that, like, they are being used as exit liquidity for this Ponzi scheme that was created. And they keep on coming up with new ways to make sure that new money enters the market by force,
We got to zoom out a bit, because this whole social contract, when you state it at under 40, and the promises to the boomers, that is the United States, which is like a minor portion of the entire planet. What does that mean? It means this story is respective of every nation around the world, and it is much more broken. Or frankly, there is no social contract in many nations, and I don't know if it's necessarily better in other nations. So this is probably the story of like Neil Howe and Fourth Turning. It's we are passing a critical threshold of the global social contract breaking, and this is historically where you get geopolitical conflict and fight over resources, and it's unfortunate and it's real. Um, there's no cure for this, and it's not increasing M2, global M2, that's going to cure any of this. So it's a precarious times, to say the least.
Precarious indeed. Here's an interesting chart. This is total reserves of depository institutions.
Head and shoulders.
Yeah, well, and it, broke through this moving average here. Last time this thing peaked and rolled over was December of 21. Which
Reserves implies excess capital or balance sheet composition, like they need this amount of reserves to meet regulatory requirements.
I think it implies well, I think here is what's to blame for this, right? This is money market funds stealing the reserves out of the banking system. Like, reserves are, like you said, they're a tool. Bank reserves are exactly as you said.
Bank reserves, not like reserve. Okay, I understand that chart better.
Yeah. So, I mean, it shouldn't surprise anyone that, as you raised interest rates, you increased this push into money market funds.
You know what's really really weird? All the boomers and old people that have trillions of dollars collectively plowing into money market funds at what, 5.5%.
Yeah.
They're fucked. Well, they're not fucked in that, you got $20 million and you're never working again, and you're spending your money and you're making 5.5% on your money. You're drawing down on your money, but 5.5% doesn't account for global capital expansion. You need about 12 and change percent for that. So these people with 20 mil making 5.5% are still losing money. But it does change what it is. It changes it at the margins, like someone with like 2 mil making 5.5% and they're 75.
Well,
Now,
they think they're making 5.5%.
like nominally.
I mean, sure. So I think part of the problem was that you'll notice that this has been pretty much an up only chart, right? But
According to interest rates,
from the from 2010 until 2017, it flatlined, right? And why did it flatline? Because we held interest rates. We held interest rates too low. So during this time, we forced the boomers into when they were making the most money they've ever made in their lives. We forced them into a whole bunch of trash because we held the interest rates so low. This is where they were buying all those skyscrapers that are now selling for pennies on the dollar, buying CMBS and like all sorts of other stuff. And there will be a reckoning for this because many sins of malinvestment were committed during these years.
Jedi's a real estate guy, so he's like, "Oh yeah, I know some dude that did $250 million worth of absolute dog shit right now."
Yeah.
Yeah.
But there, I mean, this was like their whole thing. They literally said, "Oh, we want to force people out the risk curve." Well, what the fuck do you think that means? Like, we want people to buy up a bunch of trash, um, because, like, we want. I don't know. Like, this has never turned out well historically. Like this whole idea that they teach in Econ 101 that raising interest rates, well, it decreases the marginal demand for dollar
Borrowing.
loans, right? But nobody ever talks about the freaking supply. What bank is going to supply you a loan at freaking, nothing? Like a 0% loan. What bank is going to supply this loan? Nobody is going to supply this loan. And so that's why we had 10 years where everybody was just like, well, I can't buy treasuries. I can't buy I mean, some bought treasuries as a balance sheet tool, and levered the hell out of them. And that's why we got the blowups that we did in 2020, is that you kept interest rates too low for too long. People were 50xing this shit, and in order
That's
to
why.
squeeze any sort of yield out of it, because this is, back to the Ave health factor. Like, it's like, well,
Oh
I
look,
mean, this stuff barely moves. I mean, I can lever the shit out of it. I'll never get liquidated on this.
it's even worse because it's face value. If if you're doing a loan 50x on 5 basis points, and it's an understood, it's accepted that the U.S. government's going to pay out face value. It's like it's a non-liquidatable loan, or at least that's a TradFi policy that is probably at the core of the Eurodollar market. Because who gives a shit what the market value is when this thing matures? You get a face
This is
value.
us getting more liquid. Uh-oh.
Oh, look at that
Like,
fucking chart. I love this chart.
I know it's so good. But like, here's 2017. Boom, 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 boom. Up March of 2020. This whole thing was breaking apart. And this is the part that I think a few people outside of macro wonks, such as ourselves, understand, is that this whole thing was starting to break back in September of 2019,
Yeah,
uh, before COVID really
repo market.
started. Um, and then once like the pandemic like fully took hold and the fear was at all-time highs, everybody was drawing down all their credit lines. They were selling their treasuries. They were trying to batten down the financial hatches, because nobody knew what was coming. And I mean, how many people got liquidated in all of that? Like, this
Everyone.
this is this is the kind of chart. Like, this candle is not created by people that are willingly selling. This is the kind of candle
Forward
that
selling.
that is created by forced selling.
Zoom to the
And
6 month on this chart. Yeah, I know it's a captain size. So, zoom, pinch out a bit. Look at that candle in 2020. So I have an interesting takeaway from this chart. 2020, they suppressed the entire thing, but you need a time weighted average price. Can you throw that on?
yep. Actually, I mean, I don't actually. It is on. It's just it doesn't go back far enough to get there
Oh.
because your chart's too long. Let me put it on the 3-month, and then you'll see the time wait.
Well, it's yeah. Okay, so
Well,
point
or
being,
actually,
Yellen
these are the
screams.
moving averages, not the.
Indeed, but look at that line. Look at that moving average. It's more or less kind of sort of where the time weighted average price is. Okay, so point being, Yellen and all Treasury folk will scream deepest liquid market in the world, and their entire policy is to suppress collateral volatility. They know exactly what I talk about, and I talk not that my idea is something they're drawing on, is that I'm observing something that is systemically a component of their
Obvious.
entire. Yes. So what happens is all throughout the history of this chart till post 2008 and different world prior to '08. The second collateral volatility gets too high, they implement policies and procedures to squash collateral volatility. And
Yes.
just you could just mentally draw that moving average, whatever it is, a little bit further back, and you could see it trending down. And they squashed it in 2020 as well.
Yep.
Um, and it broke
Yeah,
out.
you can
And
see like, all right, QE1, QE2,
yeah,
QE3.
the whole world, the whole system, every insane chart that we could look at, every complexity we could think of, the whole of finance
Yeah.
reduces to collateral and currency. Currency needs to expand to finance debt and to kick the can to refinance debt, probably not even just finance it. So, and that is all predicated on collateral volatility, and that is all understandable from a crypto market person's perspective in the global health factor that I talk about. So every time, so 2022 was a breakout. What did they do post 2020 and post 2022? Every policy, every facility known to man to take complete totalitarian control over collateral volatility. That is what the DTCC is. It is complete centralized
The
control over treasury clearing.
Well, but the problem is it's actually going to create more volatility because the people that are currently market making these markets, keeping volatility down, are hedge funds. And
Yeah,
hedge funds aren't going to play in this centralized market where it costs more to make these trades. Like the treasury market is market made by a very specific type of entity that I just don't think are going to be playing in this market. And it's going to be the government that's going to be having to catch this knife and not. And this is why the volatility does go off the charts every now and then, is because this is a volunteer effort to keep this chart down.
we are past the Rubicon. This is over. Anything we could think of traditional anything is done. This is government takeover of the treasury market. They will be the market maker of first resort. They will be the market maker of last resort. Collateral remains low. It may be, they will say it's not as far as China takes it. It's irrelevant. For the system in its current shape and form to continue, it'll be centrally cleared. If you're not going through the central clearinghouse, you're not trading, or at least you're trading off the books, and then who gives a shit what prices you got?
And
The
and what is that going to do to people that want to use Bitcoin as collateral?
Exactly.
And that brings us back to our previous discussion, is that like if you make you by making this, like by creating more constraints around the use of your collateral, you do
Yes.
not make it more attractive. You make it
Yes.
less attractive.
It pushes finance out
Out.
of the centralized infrastructure.
Right. And that's exactly what we've seen, is all these regulations, and maybe the Chevron stuff may help to counteract some of that. We'll see. But like the system is breaking. The system is breaking. And I want to talk about this candle right here, January 23, because this is right right around the time that you were getting all those bank failures with Signature and SVB and FRB, and I don't remember when Credit Suisse blew up, but it was somewhere around there too. And you're going to tell me, like, I've seen this argument so many times on Twitter, and it just pisses me off every time. You're going to tell me that this is not QE? Like, let me explain how this is QE, right? Because like they're like, no, it's not QE. This is something else. No, it's not. Because like, what is QE? Quantitative easing is you're
volatility suppression.
taking future dollars in the form of U.S. Treasuries, because that's what a U.S. Treasury is. It's you buy this asset, I will give you more dollars in the future. You're taking those and you're swapping them for bank reserves, or today dollars, what we'll call them. You're taking future dollars and swapping them for today dollars. So you're literally like, this is like, the kid that's like, going ham on his credit card in college. It's like, that's future me's problem. And
going ham is right.
Just for your information, adults are doing it more now than college kids.
Well, yeah, there's that too. And then
the college kids are scared. They're not really doing anything.
Yeah, because they don't even have the credit to be able to do that. But anyway, the point is though. All right. So what happened here, right? Like the move went way up. Why did it do that? Well, it was because there was a bunch of forced selling of treasuries by these institutions because they had raised interest rates and they were getting bank runs because money was all fleeing into the money market funds, which, where did I put that chart? Here's the money market funds. So money is fleeing into the money market funds. Oh, wrong way. Right here. October 22. And then boom, this thing goes vertical to the tune of like, almost $2 trillion. And that's $2 trillion fleeing the banking system. And those are today dollars. Those are today dollars that left. They're gone. And
today deposits, which are liabilities,
right. And so the today dollars are gone, and so they start selling treasuries, and then as the more and more selling of treasuries takes place, the market becomes like more and more illiquid because there's no buyers. Actually, wait, no, it's the exact opposite. All the money was leaving. All the money was actually leaving.
Less liquid.
Yes, sorry, I had that totally backwards. So all the money is leaving to these money market funds. What are the money market funds buying? Well, the Fed's raising interest rates. They're buying U.S. Treasuries, and the Treasury wasn't issuing them because we were having that whole debt debacle right here. This is the Treasury General account, January of 23. Oh,
they need bills,
interesting.
So they skew towards bills.
Well, they didn't have anything. They didn't have anything because they hadn't been issuing anything because they couldn't because of the debt ceiling. This right here was the debt ceiling. Nothing's getting issued. Nothing's getting issued. But demand is going through the roof. All the money is fleeing the banking system into treasuries. So here goes move. Everybody is trying to get their hands on these treasuries, and they're, so
put a frame it. Why is the deficit going up? The deficit isn't necessarily going up because they need to spend necessarily. At least flip it to the other side of the coin. The deficit is going up is because they needed to issue the damn bills because people are trying to buy them.
Exactly. They have to keep that market liquid. And that is what happened is issuance had to go up. And the same thing with 2020, like issuance had to go up in order to quash the volatility on
the deficit. Isn't just a deficit. The deficit is a product, and they need to supply the product.
It is a symptom. It is
Exactly.
a
Well
symptom.
said.
And so it's and this is
Market
why,
demanded debt.
like, look at this chart. This is the delta between the 1 month.
That's a terrible chart.
It's a
I,
horrible chart. Horror is bad. It's bad.
Terrible thing. Look at it.
Well, look at the volatility.
but,
I mean, you can see the
but
periods of no volatility versus volatility.
Yeah.
right,
Yeah.
like,
Yeah.
but like this
Tell me
is
that's
what
not
was
on log.
happening when we stopped issuing bills. Things started getting really wonky between the 1 month and the RRP.
Mm.
I mean, this was also
Imagine
as
imagine
we were
trading that.
raising rates, but like,
Imagine trading that. Wow.
but
Impossible.
here's the repo rate, right? Spiked in December 23. Like,
But hang on. We need to wrap
actually,
this up.
that's
It's gone quite long. I want to ask a very very important question, which is probably going to take at least another 4 hours to answer. But I'm going to let you go first, Captain Rational. And the question is, how do the next 6 months play? Obviously, with a couple of clues thrown in there with your answer, if you could, kind of like obviously this dynamic with probably a Republican government coming into play. Pre and post election, money printing, interest rates. What do the next 6 to 12 months look like? I know that, Ben, you're dying to answer this question, but I'm going to let rationality go first, and then we'll let
there's rationality, and then there's Ben.
It's very simple. Everything is very simple, which is why I'm so damn
With
calm.
you, it's always simple. That's why we enjoy your banter, sir.
The paradigm or the path remains the same. It remains volatile. And the world is always on the brink of fracturing. Something systemic is always on the brink of breaking. And the more they centralize it, it changes the structure of the system, and it's pushing it capital more and more out of centralization and into at least the market of markets that we have come to know as the crypto space, the DeFi space. So the path remains volatile with the Republican government pretty much coming in at this point. That seems clear. That's a conversation unto itself. Everything is leading in favor of what America historically is capable of: entrepreneurship, financial innovation, and that screams crypto. It screams unleashing the crypto genie. And it's just quite fascinating that they suppress the deregulation and just have at it. Just define the rules.
Yeah.
What everyone was screaming at the damn SEC about. Just define the damn rules. Let this shit out of the bottle. Let everyone do what they're gonna do, and define some rules, and to somewhat not let it get too damn perverted. So I say 6 months. We have now a decreased chance of systemic seizure, a systemic event. So decrease. We still have the chance of a systemic event. And between 6 months and 1 year, it starts to get freaking weird. And that's where moves at like 70, 60, or wherever the hell it's going to go. And that's where just the entire planet starts to go ham, using whatever collateral that they could find to get whatever leverage that they can, to do whatever malinvestment they want to do. And hopefully there's good investment, not just malinvestment. But that's where just the whole system gets sloshy full of extra cash. And that's what Raul calls the banana zone. That's what I call weird. And you can define it whatever you want. But
So essentially what you're saying is that we will enter into not just a liquidity cycle, but a max liquidity cycle. That is it likely going to be like even more than what we saw in 21, 22? Really?
Yes, yes,
Okay.
Ben, you know this mechanism. You literally just described this mechanism with the zero rate floor. You got
Yes.
bankers in Europe with what, let's say they cut rates of 4.5%, 5%. That you got bankers in Europe that just went through a decade plus of 0%. So the banks
Yes,
got
and even
cash. They were
negative. The Netherlands was in the negative for a while as well. Absolutely.
so the bankers, the bank was able to scrounge up $100 billion worth of balance sheet capacity, as Mike Howell
Mm.
talks about. And the bank's like, hey, bankers, go get it. And you're at a negative interest rate. The banker's like, what the fuck am I doing this for? I'm gonna. So they were probably deficit or incentivizing the banker, saying, please, for the love of God, sell something. And then let's say they're at 1%. Oh, the banker's like, all right, cool. I could get a 0.25% bonus. The banks are now selling cash, selling dollars at 4.5, 5.5%.
Wow.
So the
Yeah,
bank's
that's
like,
insane.
dude, go get them. Have at it. Here's 2%. Go sell
Yeah.
$100 billion. Here's 2%. I don't care. Just get it off our balance sheet and just get it. It's just going to be freaking weird. This is going to be mechanically the most interesting crypto cycle in history because it's not, the history goes back to end of '08. So the early days of Bitcoin are not comparable to the current state of crypto economics. Um, but now it's just going to be so weird. This hasn't occurred at
So,
any point in
so
time.
essentially, what you're saying is that not only am I not bullish enough, I need to actually go and get the intravenous bullish injection and the drip on all my main arteries, and I need to ride this thing into 2025. That's essentially what you're saying right now, right?
Just mechanically speaking.
Yeah,
Yes.
it is foretold.
It's in the data.
To echo his thoughts there, because I really don't disagree with any of it. There may
Yeah.
be an interesting and terrifying like part in the middle, but if it where things break and then because it's almost like they're designing it to do that. With the way that they've kept these rate hikes as high as they have, we know that there's this sort of regional bank crisis that's kind of bubbling under the surface. You have these things like commercial mortgage-backed securities that are bubbling under the surface that are nobody wants to mark this shit to market. And as soon as that re-rating happens, you're going to see some deflationary damage. And when that deflationary damage takes place, that will give the Fed the impetus they need to crank up that money printer again. Do what they do. And I mean, the FDIC is like basically already insolvent after the whole SVB thing. So like
This goes on the balance sheet.
It's all going to go on the balance sheet. It's all going to go on the Fed balance sheet because that is what happened with the QE before is that what happened is the Fed stopped paying for years and years and years. The Fed would pay profits to the Treasury in the form of remittances, and this was the Fed. It was like a nonprofit institution. They would take their excesses and they would give them to the Treasury. And then, boom, this is the cost of keeping interest rates artificially high to the tune of, minus $881 billion. So that's where those dollars came from. We essentially printed them. Like
Fed deficit is the creation of dollars.
Yes, it is creating dollars to buy real assets, or just to. I mean, we're literally paying people money to just store dollars in the RRP facility. That's where most of this is coming from. Is that we're paying 5.2% and on $400 billion, and we're doing it just for reasons. And eventually, I mean, you got monkeys in charge of this thing that have no idea what what they're doing. Like as far as like or maybe it's just that they don't know. I don't know. I bounce back and forth between these guys have no idea what they're doing, and these guys are just making shit up as they go. And these guys actually do know what they're doing. The problem is the entire system is out of control and was always going to get out of control. And
Yes,
they're
Rubicon.
doing and yes, we have reached the event horizon. And so, as they say,
Don't
buy
be exit
Bitcoin.
liquidity.
That too.
Don't
Yes.
stop leveraging shit, everyone. You realize with like most around the world, if you're outside the U.S., a couple of grand in a business, a cash flow positive business, will change your life outside of the U.S. In a lot of countries around the world, the 5-figure, 6-figure range, you're probably done after this. In the U.S., in blue states, California, New York, you need the 7, 8 figures because that shit is just disgusting in those states. In most parts of the United States, 6 figures, and you get your 10x, your 20, 30, 40x. You're done because in a good business in the crypto markets, you're making 20, 30% on the money. That changes everything. When you're making, it's going to get weird.
It
And then
is
it's going
going
to
to get.
crash. And then
And
it's
then,
going to go.
exactly. It's going to get weird. It's going to crash. And then it's going to go absolutely bonkers. And, so just
But you
hold
don't have
tight.
to. You don't have to get out when it crashes.
Yeah,
That's the whole thing.
exactly. Just
I need
hold
to.
tight.
I need
Hold
to have a
tight.
stream. I need to give people the captain's perspective of the bottom, of what does the bottom look like. I'm not going to do that to you guys. It's a half an hour, 45 minutes.
Yeah. But yes, this has been a ride. Jedi, it has been wonderful to have you back on, keeping us in
We
line.
appreciate it. Us kids, us crazy kids. Thank you.
Yeah, I find it fascinating. Like in terms of like, I know that you guys like to nerd out on the detail of it, and all. Obviously, it's important to have the fundamental and foundational understanding of how these mechanics work. But what I really enjoy about this discussion is like, what is the big picture effect of what is actually going on in those kind of like minuscule and nerdy bits that you guys obviously, I mean, you guys are like two kids in a candy store, like when you talk about it. And I find it incredibly amusing and also fascinating. Like it's like really hits those really important points, and then being able to ask the questions from a dumbass's perspective, it's great, So I really enjoy doing this from the information that I get in order to go out there and possibly sell both my kidneys so that I can get some liquidity so that I can actually go and buy a whole lot more Bitcoin and tapioca for that matter. But that's
Yeah,
another
I mean,
discussion.
the takeaway here is that like things are going to break sometime in the not too distant future.
That's
And
always
I
it's always gonna
honestly
break.
believe, and there's somebody asked a question, assuming yield curve inverts with first rate cut, is that bullish or bearish? Or uninverts? Yes. Um, I 100% believe that the cutting of rates is going to break something. And what it's going to do is it's going to force a lot of these illiquid assets to re-rate. You're going to see the commercial mortgage-backed securities, all that stuff blow up. You're going to see, but at the same time, you're going to see money maybe rushing out of money market funds to go all sorts
Chase
of other
risk.
places. It Things are going to go crazy.
Here's a bearish, bullish. These generalized terminologies. Does bearishness equate to selling?
Selling
I
what?
don't think so.
Selling
Well,
what?
selling what is a good statement, but selling anything. Bearishness, sentiment, feeling, your
I mean,
emotions. The correlation there, I think, is is not fair to the individual. It's not healthy for our well-being. We need a different methodology. You're making more money, you can spend more money. You're making less money, you spend less money. Make sure your balance sheet is solvent. Don't blow yourself up, and that's how you live.
Yeah. And I think it's important that this being a macro show, we work on macro timelines. I mean, look at the charts that this man makes me pull up. 6-month candles. Like, we're not working on like the 2-week chart here, or the 1-week chart here. Like,
Check back in 2028.
right. I mean, this is about having a long-term thesis, right? And it's so antithetical to most of what you see in the crypto space, which is like, oh, hey, the president almost got his ear shot off. Which meme coin am I going to buy that has the president's ear in it?
Oh
And
dear Lord.
then dump it
Did they
by
really do that? I
oh
think they
yes,
did.
there were many competing ones.
Oh, that's horrible. That's so insulting.
But
Listen, I hate it. I hate politics so much. I don't even like to talk about it. But in the end,
but
everyone's a human. Everyone's a person, and that's some fucked up shit. You don't shoot at people. It's horrible.
yeah, but there were meme coins being created, and everybody's trying to decide what that is a very different time frame. Like that is get in, get out.
Yeah.
This is what assets am I going to hold and comfortably hold for the next 5 years?
10
And for
years,
me,
15 years, perpetuity.
yeah,
There's plenty of reasons to hold that shit in perpetuity. Plenty of business
yeah,
reasons.
Well, I mean, the thing is that that's where the wisdom in investment comes in, right? It's not just, well, let's have a willy-nilly conversation about, whether I'm going to buy a shopping center down the road because it's going to give me a 12% yield, on a 20-year lease or several 20-year leases. I mean, that's a big move, because you're going to pay a lot of money for it. What is the kind of benefit of buying an asset like that? What are the depreciation aspects of it? What is the the credibility of my tenants within that asset? And it's like that then becomes another 16-hour podcast. Like, how do we go about buying the appropriate assets to secure our wealth? So Naval talks about wealth versus having money
know your
versus
time frame.
status. Absolutely.
Time frame.
I mean,
Yeah.
what is your time frame? What is your horizon? What do you actually want to achieve from a financial standpoint in this reality? And we've been speaking about it quite substantially around, like, what am I, to quote Captain Rational, what am I prepared to pay for a salary? And I'm going to continue saying this over and over again, because that's where real wealth resides. Wealth doesn't reside in a fucking Lambo, bro. The Lambo means nothing because it
That's a
doesn't give
liability.
you money. That is a fucking liability, and it's a status symbol that's not actually going to give you anything besides a measure of how tiny your dick really is.
It will give you a lot of male attention, is what it'll get you.
You need to be taking that money and you need to be investing it in assets that make you money whilst you sleep. And that's where the real
Warren
enchilada
Buffett
lies.
quotes coming out of this man's mouth.
Yeah. And it's
Holy
true.
cow. It's real. I love
It
that.
is real. It is real.
I live my life on that at this point. I would give up everything to be able to sit in the backyard and click a button for what I used to make when I was a kid. I think it was like I made like I think I remember $500 every 2 weeks working as a lifeguard, and I mean, all right, that quick check that off the bucket list. Make $500 every 2 weeks.
Yeah.
So just bump up the numbers, because if you could buy $500 every 2 weeks, do it again, get some more money, do it again, and then all of a sudden you're making like $5,000 a week, and you're pretty good. Pretty sure that's done for
And
most.
what's also really interesting about this discussion is that you don't actually need that much. Like, you reach a point where you don't actually need that much. You don't need to live in a 25,000 square foot home, and you don't have to. You know what I mean? It's kind of like you realize at a certain point that It's about it's about experience. It's about being able to spend time with your kids. It's about being able to have podcasts like this where you actually have time, where you've got the most precious thing in the world that you can actually use to make yourself
back your time. That
is
everything.
actually what it's all about. And it's like, it's not a theory. It's not my idea. This is what fucking Plato and Aristotle and all these dudes have spoken about since the beginning of time. And we just need to sit back, pay attention, and actually read what is important, as opposed to what we think is important and what fools tell us is important.
Yes.
The $5,000 turns into $2,000. Spend less. Relax. Go in the backyard. Spend less. Eventually, that $2,000 turns into $8,000. $8,000 turns into $4,000. $4,000 turns into $12,000. Why? Because the whole system's expanding, and it's all nominally inflating. And this entire market of markets is monetizing. So you get higher lows and higher highs.
You know what I want to do is quite soon, actually, is that I would love to do this podcast, Exit Liquidity, but primarily focus on what were the lessons that were learned around the macro context and all the nerdy stuff that you guys have done that have been implemented into the money market protocol that is Tapioca in its evolution right now. That is a podcast that I would love to do.
One.
I would love to do that.
Of course you would.
We can we can set that up. We'll set that up sometime,
because
we'll get,
you're talking about dynamics and interactions and like a whole lot of theories around kind of like how does money kind of operate from point A to point B, whether you're lending, borrowing, in the DeFi context, right? Where you take TradFi as your working example. How do we then apply it in a DeFi context? Right now, that is the whole premise around the way that Tapioca has been built. But I want to explore like what went wrong in TradFi and is continuing to go wrong, and how does Tapioca plan to solve those problems? Obviously, right now on a very micro scale, because you can't compare it to anything. It's still very much an experiment in the laboratory. But I'd love to explore kind of like what that looks like as a 0 to 1, and then how does it really look like from a 0 to 100.
In fairness, there's many solutions. And it's not necessarily solutions, it's extensions or iterations. There's risk in everything, but these things are better for reasons of immutability.
Well, you've been very bullish on CRV and CVX and kind of like the ideas, and Arve has done a lot of really positive stuff where we know that shit can work. And we know that the dynamics of X, Y, and Z can work in the confines of whatever those confines might be that we will explore and discuss. But we know that it works. Now it's a question of how do we expand it so that it can be scalable and, more importantly, used by pretty much everybody. Those are the questions that I would love to answer.
Those are the good questions. We just have to remember that there's many solutions to problems, and each one has different approaches. And collectively, Tapioca kind of encompasses all of them: money market, credit market. Oh dear. Incentive regime, protocol, and liquidity.
We've been talking for an hour and 53 minutes though, and that was the first time it got mentioned.
So you know what's really funny about this is that we haven't mentioned Tapioca once the entire
honestly
stream,
on this show.
And then as Techno Dimension walks in, I obviously bring up this topic because all I can think about is this whole DeFi context of how money works and how it can be expanded. And obviously I mentioned Tapioca because I am a complete Tapioca shill, but that's another story altogether.
And it's funny because I almost actively try to avoid talking about it on the show. Like I literally told him I'm not even going to show the Tapioca chart because like I don't like talking. First of all, I will not like talk price. I don't even talk price on Tap Talk. Like I'm
not interested. Honestly, dude, I said it early on in a tweet. Someone was posting the chart, and I actually turned around and said, "You know what? I don't care what the price is. I really don't. For me, it's like I'm genuinely invested in this product that can really do what it says on the box. Like that's all I actually like. That's my my interest is just like, will this thing work? And if it does, there's my salary. That's all I think about that.
Yeah.
Build every fintech protocol known to humankind into a single business operation.
Yes.
It's quite extraordinary. And the protocol and liquidity, Frax written all over it. Incentive system, where where you're building
Single,
protocol. How do you even I don't even know how to start the conversation, but it doesn't stop
yeah.
because you have to, once you start the tap conversation, you have to discuss the status quo and precedents. So it all starts from Curve. They were the first to
Yes.
have liquidity
The bosses.
financing
Yeah.
and governance.
There's so many inspirations to where we are right now. And this is the whole point, right? It's like mistakes have been made and mistakes will continue to be made, not only by wallets that individuals control, but by protocols and in terms of how they interact with people and how people interact with them and all that beautiful stuff. And what I really enjoy about DeFi more than anything else is the fact that there's an evolution that really is happening in front of our eyes, and there are people in the space that are fucking doing great stuff, and it's a shame, because I think this cycle, more than any of the other cycles, we're seeing more innovation and way more thought going into what people are building. But because everyone's attention is elsewhere, people are, and even the OGs, the so-called OGs in the space, are saying, "Oh, but there's no innovation in the space," and it's like bullshit, brother. There's so much innovation. You need to stop looking at. You need to stop looking at your underwear and your meme coins, and you need to actually look outward and see that there's some seriously good innovation going on right now that can actually change everything in this game.
It takes time to build actual innovation.
Yes,
too.
it does. Well, we learned that with Tapioca, and there's a whole lot of others where it's taken, where I will build it in a year, and it's taken 2.5 years, and it will probably take another year, even longer, to get to the final iteration of it. You know, it's like, fuck.
Oh, I don't think we'll reach the final I mean, we've got so many different things in store when it comes to that, but
it's a constant iteration.
I mean, and that's the thing,
Yes.
is we're gonna just like the rest of the crypto space, it's just going to keep moving and iterating, and tooling will be built out, and it's just going to continue to get bigger and closer to the finance that already exists, but it's going to be on chain, and it's going to be immutable, and it's going to be permissionless, and maybe sometimes permissionless.
It doesn't have to be completely permissionless.
It doesn't have to be. It doesn't have to be, but it doesn't have to be either of those things. And that's the thing, is like, everybody likes to see everything in black and white. Like, it has to be immutable and permissionless. And it has to be, I like the safety of my bank, blah, blah, blah. And then there's these two sides, but there's like this whole building space in the middle that you can have some of this with a little of that, and some of this over here. And the point is that you're going to be building products that people want to use. And
so let's leave it at that. Let's say good afternoon, good morning, good evening to everybody. But we are going to reconvene this meeting with the very, very important questions around what lessons were learned in the making of Tapioca that will not be repeated in the product that will be Tapioca.
Okay, we can do that.
Let's frame it with the grandest of scales. How did we get to where we are? Where were we? And
exactly.
How did we iterate? And in conclusion, these are banks. It is a bank. Yeah. This is banking infrastructure. And
it's a money market protocol. What does that actually mean? And exactly. What does that mean?
Money market is a banking product. Credit is a banking product. Period.
Yeah.
I can't wait to use that.
I think I think that would be good. Maybe I mean, should we do it here, or should we do it on Tap Talk? Like, bring in Captain and bring in you on Tap Talk, and
we're gonna do it here, because this is where the idea was born, and you guys aren't gonna get that
Very
luxury.
good. Very good.
This is my idea, bitches.
All right. You're
I
the
love
boss, man. You're the boss, man. This is Blockmates TV, and you are the Blockmates. So you, I will concede to the boss, man. All right,
Cool.
but
Gentlemen, always a
till
pleasure.
next time,
Thank you.
don't be exit liquidity.
Stay rational. Peace.